Let's bring another voice into this conversation here, talk more about the impact on your money and investments. Joining us now is Joe Zidle. He is Blackstone's chief investment strategist, and he has been on the mark about this. I think probably, unfortunately, with all due respect on that, is now the time, right now, for our viewers to buy stocks?
No, I think we're going to see more downside volatility, unfortunately. And I think, kind of what's happening here is investors are struggling with pricing in risk versus uncertainty. And they're two very different animals. And, if you think about the idea of pricing in risk, when you've got risk, you have some known outcomes, and you can assign probabilities to those outcomes, and you can start discounting them, right? The coronavirus was known to the markets as early as late December, and yet markets performed pretty well because they viewed it as a risk. They could estimate probabilities of China GDP, of supply chains, et cetera. But that all changed last week when the coronavirus spread to 28 or 29 different countries. Now investors are dealing with, how do we price in uncertainty? We don't know what the range of outcomes are at this point, so we can't even begin to discount them. So that drives more volatility. I'll
give you an example, and not in no way am I trying to say, toot the horn or whatever, but 3 weeks ago I went on the exchange, our 1 o'clock show, and I did some math. This is the early days, and I said oil demand could very easily fall 2 million barrels a day, and I got some nasty grams. People said, you're extreme, fearmonger, blah, blah, blah. That seems now to be the base case. Again, I'm not saying that I knew more than anybody else, just aggregating information. My point is that what we thought and what we know then and now is very different. Couldn't that be the same thing now versus 3 weeks from now?
Yeah, I think it is a fair point. And again, at this point, I would hesitate to endorse any estimates on the impact that this might have on GDP growth or on companies. My own view is that we're going to face a series of mini rolling recessions, especially among those countries that are most trade exposed, right? Those are the countries, your Singapores of the world, your South Koreas, the economy of Hong Kong, of course, Japan, and even in Europe, where Germany is very trade exposed. Their net trade as a percent of GDP is about 90%. Their growth was already weak. I think we'll see many rolling recessions, but these things are transitory. Global health emergencies, the history on these is clear that they are transitory. It might take several more quarters from here, but I think it'll pass. From a company perspective, I think earnings estimates are still going to have to come down pretty substantially. The street started the year looking for about 10% EPS growth for the year 2020. Now we might be down to about 7% EPS growth for the year. I think that's going to have to come way down. And there's 2 to 3 quarters where we're not going to be able to handicap this. I do think that there will be a period in which we are going to want to go and deploy capital and start thinking about high conviction or long-term themes. I just think we're going to see more volatility until then. Yeah,
it's interesting, Joe. You were talking about a move to the downside in the fall. I mean, a lot of us were. Now it's something to come to fruition. The coronavirus, people are using that as an excuse. I get it. It's obviously part of it. But a lot of the reasons why we're lower are far more, I think, far-reaching than just this. So is this just the final straw, and the fundamentals were sort of in place for this move all along?
I think that's a really good point. In September, the Fed completely reversed position with respect to its balance sheet. It started expanding its balance sheet in ways that we hadn't seen in a long time. And with that, you had a massive move up of risk assets, in equities among disruptors who were up 50% from, mid-September until last week. You saw it across the range of fixed income, where a lot of countries started moving back into negative yielding debt. And, what you really had was this feedback loop that I'd never seen before in my career, where good news was good for the markets, i.e. trade resolution with a phase 1 trade deal, news of Brexit. Then bad news was better, i.e. the U.S. preemptively taking out General Soleimani and a spike in oil prices. And then the worst news is human tragedy of coronavirus actually drove markets higher. Up until last Friday, in 35 trading days, you had 18 new highs in the S&P 500. Good news was good, bad news was better, and the worst news was the best. There was a famous economist named Herbert Stein who's famous for saying, Stein's law, that which cannot go on forever won't. Right? And I think that's an example of what we're seeing. Now, I don't know if the coronavirus is going to be enough to break this feedback loop, because we're going to see central banks all around the world flooding the markets with liquidity. I think the Fed will have to cut at least twice, maybe 3 times. So my guess is we could be back in this feedback loop, but really it's a story of liquidity. And I think that's been the main driver since the fall.
So one of the points you made just a minute ago was this idea that once it flushes itself out, we should actually see a recovery from this. And if you look at sort of studies of global pandemics, and we don't have that many to study, but St. Louis Fed actually did a study of the Spanish flu, and basically they said after about 6 months of pain, you saw this boost in productivity across the economy, and the economic impacts are actually quite positive 12 months and 18 months out. The problem that we have here is we have these massive valuations, and to Guy's point, I think a lot of the underlying fragility of the economy is really starting to flush itself out. How do you play that, sort of knowing that the economy might suffer for 6 months and then get better, but we are at such valuations?
Yeah, I think you raise a great point. And the idea and the way I've always thought about this is the trends that will go into a global health emergency are going to be the trends coming out of it. You know, these things are awful. Our sympathies with everybody who's been impacted here. But from an economic perspective and even a company perspective, the trends going in are going to be trends coming out. So I think the big question will be, what are the trends that we're looking at, 6 months or a year from now or 2 years from now? We're looking at a global economy that was already suffering from diminishing returns of debt. The last decade produced record high debt, record low interest rates, and ever increasing multiples. I don't know that we repeat that. I think it's going to be a lower return environment. It's going to require higher conviction investing.
Joe Zidle, Blackstone. Joe, pleasure. Thank you very much. So, Tim, I guess the question is this, following up on that, when this is over, we don't know when that is, but let's hope it's sooner than later. Do stocks just resume their upward momentum that they were on for 3 years, 4 years before this?
So we have to balance the two forces that we've just talked about, which is that you had a immature and fragile recovery that was, something we were questioning recession certainly 6 to 9 months ago. And so if I think about the market right now, yes, I think we want certainty. Joe talked about the lack thereof, and that's something that the market can't handicap. I do think we're still going to have the Fed that is going to be throwing everything they can. There's going to be talk of fiscal, and they're certainly going to get fiscal around the world. And you're going to get to a place where at some point valuations do matter, and valuations in a zero-rate environment are going to be more compelling faster than they might have been otherwise. So, again, back to the market, you want to look at where we actually have taken out this last excess Fed run. It takes you back to basically the 200-day. Takes you down to about either 30, 35 on the S&P, or if you want to get back to essentially what was the highs of Jan 28 blow-off top 2018, or actually where we got to in the fall before we took off on that run, it's around 2,900 on the S&P. And then I think you have people able to make some choices on valuation and also where the market is actually taken off that last round of excess.
I just think I was spot on the Fed. They were maybe out of the game when the market was doing better, which is only, 12 days ago, maybe? And even with economic numbers being okay, they were out of the market, but they're not anymore.
And by one quick comment on this, I know we got to get to Meg, but I want to ask this because we had the Democratic debate last night. And without getting we're not going to get political. It's not what we do. But when people are throwing around numbers, you have to dive in. Is there any part of this which is related to the fact that there are people on stage that are very possibly going to be the next president, or at least in the running, that are suggesting we do away with certain industries and throw oil executives in jail?
Yeah, 100%. I mean, we've mentioned Bernie Sanders by name, so we can
literally
say
says
it.
We should send fossil fuel company CEOs to prison.
And what's interesting about that, when he was doing very well, people took that as a positive because they're like, Donald Trump is going to annihilate him in a general election. Now I think people are saying, you know what, maybe that's not a complete certainty. So maybe there is some of the Bernie Sanders factor in this.
Yeah.